Hey guys, welcome back to another video. Today I'm going to be providing you guys with a step-by-step guide on how to get started in the stock market. So before we head over to the first step, a few things to note are firstly, you should only look to invest what you can afford to lose. So the best way I look at it is that all my funds that I allocate to stock-based investing, I've mentally parted with that money, and as such will not be financially ruined in the event that that money disappears due to the stocks tumbling or the companies that I've invested in failing. In addition to that, before you even consider investing in the stock market, ensure you have an emergency fund stored away in a bank account that can help you out in a rainy day, such as when you need to go to the hospital or your car breaks down. Because investing in the stock market, ideally you will not be pulling money out to fund your emergencies. In addition to that, stocks may not be the best investment for your current financial position, so you should investigate exactly what you expect from your investment and tally up whether or not a stock-based investment is the best for you. Furthermore, ensure you have the ability to remove emotion when investing, as oftentimes this can be a large factor in what results in people losing out on returns because they get emotionally attached to the investment and as a result sell out too early or buy when the market's at an all-time high. So an ability to part with your emotions while investing can be hugely beneficial. The stock market also can be very volatile at times, and as a result of that, you may see your capital appreciate or depreciate. And sometimes it can actually depreciate at quite a quick rate. And as a result of that, you need to be mentally prepared to see those drops and also gains without getting too flustered or mentally strained. But the great thing about the stock market is over the long term, historically, it's managed to provide an overall positive appreciation on people's money. And this data shows that if you are invested in the stock market over an extended period of time, you are almost certain to receive a return on your investment. Now, the first step in the investing process is to find yourself a broker. This can either be in the form of an online or a full service-based broker. A full service broker will provide you with advice on shares to purchase and will provide a helping hand throughout the investing process. An online broker is one that is considered execution only, and there is no advice provided on what shares to buy. As you would expect, the full service broker will end up costing you more in fees relative to the online broker. And this is a decision that you will need to make based on your current understanding of shares and whether or not you feel comfortable making your own purchasing decisions. There are many brokerage platforms out there. I'm currently using SelfWealth, which is a brokerage platform that you'll see on the screen now. But there are many other brokerage platforms out there such as CommSec, which is offered by Commonwealth Bank, and NAB Trade, which is offered by NAB. Feel free to do your research on exactly what broker fits your needs. I personally use SelfWealth because of their low fees. It's $9.50 per trade regardless of trade size, and that's currently the lowest on the market, whereas some of the other brokerage platforms charge a fixed fee as well as a percentage of the trade volume. The second step is choosing a stock. Now, there are two types of stock mainly, one being a blue chip based stock, which is a stock that is of a large, well-established and financially sound company that has operated for many years. And these are generally considered far safer than the alternative, which is a penny stock. A penny stock refers to a small company that typically trades for less than $5 a share. They have higher risk, but potentially have a higher payoff, whereas the blue chip has lower risk, but has more modest returns. So depending on your risk appetite, you will need to determine whether or not you want to go for blue chip based stocks or penny, or potentially a mixture of both. Now, there's two ways that an investor makes money on their stock purchases. The first is a capital return. So capital return refers to the appreciation of the stock value. So if I was to buy a stock at $100 and then a year later it was worth $150, I would have made $50 per share that I own, and that's considered a capital gain. In addition to that, some companies decide to provide dividends, and that is in the form of a cash payment to their shareholders. And the dividend value is a percentage of the stock price, and the percentage differs between certain companies. Now, you may be wondering, why don't all companies pay dividends? Well, that's because some companies decide to reinvest their dividends into their business activities in expectation of future higher growth. So they'll reinvest into the firm's infrastructure, into the business processes and stuff like that in order to generate more revenue in the future. As a result of those activities being conducted, the share price in terms of capital return is likely to appreciate at a faster rate than a dividend paying stock. Step 3 is placing an order on your particular stock. So for example here, if we're looking at SelfWealth, we can just jump in and we will look at Commonwealth Bank, which is the ticker symbol of CBA. And a ticker symbol is just a 3-digit code that represents the company on the Australian Securities Exchange. Now, if you're using SelfWealth, you'll receive an interface very similar to this. If you're using a different brokerage platform, it will differ slightly, but the overall idea will be very similar. So we can see here that we're currently searched for the Commonwealth Bank of Australia. It currently trades at $82.24. And if we want to place a buy order, we navigate to the buy button here and we can click on this. Now this is the order interface that we will be interacting with in order to place our buy. So firstly, we can see that the order type is a buy. We can either select value or quantity depending on whether or not we want to place an order based on a fixed amount or if we want to buy a certain amount of Commonwealth Bank shares. So for this particular instance, we'll put in a quantity and we'll put in 100. When it comes to price type, we can either put a market then limit or we can put a limit order. A market then limit is where a trade will be executed at the market rate, meaning what is the stock currently trading for. Whereas a limit, we can define exactly what we want to pay for that stock. So in this instance, we can have a look over here for the day low and day high, as well as the last price. At market close, we can see that it was previously trading at $82.24. So if we wanted to buy it at that particular price or around there, we could put in a market order. If we wanted to buy it for less, we could then maybe put it in for $81 or let's go $82 on the dot. Like that, and then we can either define exactly how long we want this to last for, day only or good till a day. We'll just leave it for a day. And once we're happy with what we've got here, we can then click review order and then place order. I'm not going to go through with it because I currently don't have the funds to do so. But once we do that and we place the order, it will be listed here in the market depth, which represents the buyers and sellers currently placing orders for the particular company. Then when the market opens tomorrow, if someone is willing to sell CBA at $82, then our order will be filled and we will then own that amount of shares depending on how many are filled. Now, also just to note, the brokerage fees here is $9.50, so $9.50 per trade that you make. That's on a buy and sell order, so you'll pay $9.50 when buying, and then when you wish to sell the stock, you'll also pay another $9.50. If you want to sign up to SelfWealth, I'll leave a referral link in the description below, which will provide you with 5 free trades when you sign up, and it'll also provide me with 5 free trades. So if you want to get started on SelfWealth, you can save yourself a bit of cash by signing up and getting your first 5 trades free. So the 4th step is monitoring and adding to your portfolio. So once you've completed the first purchase of your stock through the brokerage platform, you can use the platform that you bought the stock through to monitor the performance of your particular share. And so if we head over here to the My Portfolio tab, we can get a bit of a breakdown of our shares performance. And here we can see a bit of a graph that shows us a percentage representation of the performance relative to the market, as well as a target portfolio that I've elected into. In addition to that, we can get a bit more of a breakdown to our estimated yield, which is the dividends, as well as a few other key metrics such as the weighting of our portfolio, the weighting of each stock in our portfolio, and total profit and loss, as well as the percentage day change. In addition to that, you may also want to look at adding to your stock portfolio. So over time, as your salary increases or more funds become available through budgeting, it's great to add to your portfolio to increase the effects of investing, so through compound interest. So ideally, you'll be investing maybe on a monthly or half-yearly basis with funds coming from your salary, just so you can really reap the rewards of investing over an extended period of time with a constant cash flow of money coming into the market. Also, once you've finished completing purchasing your first stock, you'll need to sign up to a share registry. You'll receive a letter in the mail dictating exactly what to do when it comes to the share registry. So a share registry is a third party that is nominated by the company you bought shares in to track the shareholders' shares. There's also a place in which you can opt into dividend reinvestment plans. So a dividend reinvestment plan is a simple and easy way for an investor to have their dividends reinvested into the stock. So for example, as opposed to receiving a $100 dividend from my Commonwealth Bank shares, if the stock price was trading at $50 each, I would receive 2 Commonwealth Bank shares as opposed to the $100 dividend. So the fifth and final step is tax. At tax time, you must calculate the tax payable from your share trading by tallying up your profit, losses, and dividends. It should be noted that if you hold the share assets for a period longer than 12 months, then you only have to pay capital gains tax on 50% of your overall gains. And so that's an effective way to reduce your tax. Because if you're selling them within 12 months, you'll pay a full 100% of your marginal income tax rate on that particular capital gains. And with the dividends as well, there are tax advantages with franking credits, which you feel free to look into a bit more, because if you are investing in Australian-based companies and they frank their dividends, you can receive cash back depending on your current income rate or tax rate. Thanks so much for watching, guys. Hopefully this video provided you with the foundation to get involved into the stock market. If you have any questions, feel free to leave them in the comment section below. If you enjoyed the video, please leave a like and subscribe. Cheers.